We have been flattening out today, and you want to be very careful here because we've got a series of market leaders that are kind of flattish. And the reason is it's hard to advance the market because it's pricey right now. We've got to resolve some issues. Let's just look at the sectors. Let me show you 4, maybe 5 sectors that have really been the market leaders since the December 24th bottom. So semiconductors are up, what, 25% since December 24th? The S&P's up 18%. Home builders up 25%. Industrials have been roaring. They're up 25%. And energy, well, you know what's been going on with oil rallying. They're up 25%. Energy's up today. Devon had some overall positive news. They added to their buyback, so that's helping them. But it's looking a little flattish right now, and I think one of the big problems is this trade issue. So the market is pricing in a trade deal, but the question is, how much is priced in? So let me ask you a question. Here's a thought experience. Suppose March 1st, a trade deal is announced. What happens to the S&P 500? So we're at 2,800 right now, roughly around there. Would it go to 3,000? I tend to bet against that. I think probably not. I think a lot is already priced in, modest upside. How about, though, the opposite happens? March 1st, no trade deal, tariffs go to 25%. Would we drop 200 points to 2,600? Oh, yeah. I think we would drop more than that. In other words, I think there is more risk to the downside than there is to the upside right now, and that's one of the reasons the market, I think, is having some problems advancing. So here's the question. Okay, what will advance the stock market? How do we get over 3,000 right now? So let's assume that the impact of the trade deal, assuming one happens, down the road, even if they extend the deadline, would be fairly modest, but still on the upside. How about some other things? Would there be anything that would significantly move the market? Yeah, there's 3 obvious things right there. If we saw evidence that not only were central banks not raising rates, but they were in an easing mode, including the Federal Reserve, that would make a difference. How about this constant talk, which I started a few weeks ago, about the earnings recession? How about that going away? How about we get 2 or 3% earnings growth for the year and everybody comes to that conclusion? I think that would have some psychological impact as well, and I think that would be significant. And how about, finally, the most important thing of all, a global slowdown? How about better signs of European not going to below zero and Italy not going into recession? How about China stabilizing headlines? Those would make a significant impact on the markets and I think would help move things forward. The problem right now is the market is very pricey. So look at right now. Suppose you've got this crowd that believes there's going to be 0% earnings growth. What's the multiple right now at 2,800? 17. Wow, 17 for no earnings growth? That's a very hard multiple to argue. The market is very clearly overpriced if you're at 0% earnings growth. If you have 5% earnings growth, which is where we are, a lot of people think for the year, 16, still a bit on the pricey side. Remember, the historic average earnings growth is about 6 or 7% with 15 to 16% multiple. This is hard to argue right now that the market is cheap in any way. And remember, a lot of the strategists, they're all around 2,800 to 3,100 for the year. For example, take a look at some of the other ones that are out there. Morgan Stanley was already at 2,750. That's Mike Wilson. Bank of America, Goldman, JP Morgan, Barclays, they're at 3,000. If you're at 3,000 with 0% earnings growth, boy, now you're at 18 times forward earnings. What's the point of this? The point is it's very hard to move the market forward unless you get earnings multiples down, global growth a little more stable, and some kind of clear trade deal.